Joining me now, CNBC contributor Tom Lee of Fundstrat Global Advisors, right here on set with me. It's good to see you. Welcome back.
Great to see you, Scott.
That's the headline we're going to start with, 4,800 by year end. I want you to tell me how.
I think if I had to say market internals, it looks like it's baked in the cake in the sense that markets that make this much progress by day 26, 16 out of 17 have been over double-digit returns and with an average gain of 26%. So I think that the market's revealed its hand. From a fundamental perspective, I think the narrative is inflation is becoming less of a risk to the upside. And from a Fed's perspective, that's a more predictable Fed. I think that allows volatility to come down. I think multiples expand and earnings hold up nicely, and we get, investors buying stocks, buying the dip again.
Okay, so I love what the show before us did right off the top, the way they put the debate. Don't fight the Fed versus don't fight the tape. The Fed is still highly engaged, okay? You obviously are saying don't fight the tape. The signs in the markets at this point, at the beginning part of this year, tell you that none of the other stuff matters anymore. Inflation's coming down enough. There are too many good signs in the market to go back now?
It would be unprecedented, Scott, and just in terms of internals, because we've had such a breadth expansion and the market's producing this much upsides in such a short time. It's never happened in a bear market. But when investors say don't fight the Fed, I think that they're forgetting that there's not just Fed is not a binary mode. Fed's not just cutting or they're hiking. There's also the Fed that's trying to gradually and be predictable in monetary policy. That's the Fed of the 90s. The Fed was raising rates really for almost 10 years, and the stock market had double-digit gains. So I think predictable rate increases is not the same as the Fed wanting financial conditions to tighten to lead to a recession.
What if they're still unpredictable, right? That jobs report was pretty hot. What happens if the CPI is as well? What happens if subsequent inflation reads are not as good as we think they're going to be? I feel like things are still a little uncertain to be, as Jamie Dimon would say the other day, it's too early to declare victory.
You're right. It's too early to declare victory, but there's a difference between the Fed reacting to every data point versus a Fed that wants to be predictable. It took 3 good inflation reports before the Fed even started to use the word disinflation. But from December to February, they went from 0 citations of disinflation to 13. So if the February CPI report is a little bit hot, which we don't expect, we actually think it's going to be another downside read, so that'll be 4 to 5 consecutive months. That's a predictable Fed. We had one somewhat hot jobs report. If the Fed starts raising rates there, that's a Fed that's reactive to data points, almost backwards.
Aren't they? But they're telling us to this point, aren't they, that they're going to be data dependent now? They're not on some predetermined path like some in the market had feared they were at one point. They actually suggest they're going to be data dependent.
Yeah, but there's a difference between data dependent and data reactive. I think the one thing that's going to be important is for the Fed's reaction function to make sense. I think most of us would agree a lot of the economic data that they cite, CPI and jobs reports, is backwards looking. I mean, for instance, high-frequency data showed inflation was weakening since June, but the first good inflation report wasn't until October, and then it tanked since then. The Fed hadn't even talked about progress on inflation until February of this year, another 4 months later. I think if they're going to start to talk about jobs reports as the reason to move monetary policy, it is a little backwards looking because jobs is the last thing that reacts to monetary policy.
It may be backwards, but they're clearly focused on cracking the labor market, right?